high. This could make this in a higher high here as well, just in terms of the bounds of this conditions. But we needed to look back and say that, you know, horizontally speaking, this is still not above that zone. So failure in around this area, how would that look? And this is the flux that you get with this elastic band in these periods of time, because then naturally you could be looking at it coming down towards testing off of where this area was before you'd be able to tell. And that means that puts in a range on this thing, the potential wise of going a good solid 7 or 8% before it would be able to say whether or not you might be able to look lower, or whether or not you should be looking lower at that point. So to answer my friend's question there, just off in the terms of the pure basics of the thing, that well, there's a much greater chance of you being able to buy in at 109, but not purely off the basis of that being 109s being closer than below $1, but off the basis of the fact that, like, where our last low was. Now, if our last low was down here at well, just not quite there, but just in around about here, no, not quite there, just in around about here, then and whatever, then it'd be like, man, yeah, totally, and whatever else, and you're looking for that 20%, but that didn't happen. Now, if it does happen, then what does that mean? The implications of it are that if it did happen, then it means then your question next time is going to be around about, you know, in terms of if you're thinking about this from a value proposition, and you're asking about something that's would have to drop 23%, 20 whatever to get down there, then you're looking at this, you're asking big questions. And then if that did happen, it would change the conditions under which you'd be answering that question. Should it be happening again? You know, it would make it so that, of course, it'd be much more likely, blah blah blah, this is a downward trend. I mean, look, we'd have failed here. This would be a lower high, this would be your low, and this would be your lower high. This one here, none of this piss in between. That'd be that flux. So this is what I talked about. This is the flux, and because of that flux, then what it leaves you with is a 7% opportunity here, which is a far greater opportunity just in and of itself than an opportunity to get in at below $1, right? So if you can understand this is a key component, right? This is advanced. This is the key components here. This is how you make money. If you can understand that the opportunity here is much greater than the opportunity down below, given the ability that you have to manage your risk. So if you're a speculator and you're based off of managing risk as opposed to some other sort of complete fucking nonsense, and I'll tell you, there's two ways of doing things in the world. There is the complete fucking nonsense way, which does not work, and then there's managing your risk, which does work. And I specifically teach people the try, and all you have to really do is pay close attention. Well, like I say, I'm not a financial advisor, none of this financial advice, but you'd be saying that the opportunity that exists there is bound within the parameters of being able to manage your risk based off of the areas where the prices have been before. Essentially, on that level, it's like past price action does not predict intrinsically or inherently predictive of future of the future. It certainly is not. It's not at all. But it is absolutely indicative of the past. It's, you know, set in stone at that point. It's really good to know that in the past that's where that was, and that they can then manage your risk, which is an assessment of what is known, right? The risks versus what is unknown, as in nobody can really make those predictive things. Right? Great. Okay. Well, I'll position myself on that position where it's like, well, up to the point where you're like you're saying, like that nobody can tell you. I can base myself between these two things, and I'll have a lower risk, right? So therefore, I make money and stay alive as a trader. And then the other one is, well, could I get in at this point here? And it's like, yes, you could, but the question then obviously naturally becomes, where are you managing your risk at, and how are you doing this, and how does this work for you? So what you got is the two types of people, and the one type of person is like who I talk to, and actually is everyone that's successful, whether they make that home run today and they never have to do this ever again from tomorrow onwards or not, is in that one group there, that one bit box there that thinks about it that way. It exclusively exists within that parameters, right? And then there's this other group over here, and what do? They all ultimately lose all their money. Ultimately, they will. That's what they all do. All of them do. That's what they all do. They all ultimately lose it, right? Doesn't matter. Doesn't matter, man. Doesn't matter. You think that you'll stop. You won't. You'll lose all your money. All of it. All of it. All of it. I'm not joking. All of it. I'm not joking. When your house is being taken off of you, and then you will know that that was the truth. And that is the gambler mentality, right? And that's because they don't manage the risk. They don't know how to manage the risk. They don't have risk management. They just lose it all in the end anyway, because the markets are not really actually, you know, designed to take money from you personally, but the markets are designed to take money from people's pockets. Because what is it that you're doing if you add sell side liquidity here at a pivot point. Well, it's pushing it further down the way, isn't it? So what you're going to have is you're going to then have two types of people. You're going to have the people who are doing that on the one hand, who are doing it because they're actually trading. That's a T for trading. And then you got the other ones who are the gamblers, right? The gamblers. And you know what the gamblers do? The gamblers, they experience the same pain where you have to give something back to the market. But the traders, what they do is they assess it and they get it right the first time. And they right the first time is just the principle that they're not going to conduct mistakes twice in a row. And then these guys here, they just gamble. So whenever these guys capitulate in the market, they're capitulating based off of a risk dynamics that they've worked out, which is consistent and scientific. Whereas whenever these guys capitulate, the other ones, gamblers, it's paper handing. Right? It's all it is paper handing. And what do we see in terms of these heavily speculative markets? Well, we see just shit tons of paper handing constantly. It's the truth of it. What do you see in this market over here? You see tons of paper handing. What do you see in this market over here? You see tons and tons of paper handing. What do you see in this market over here? Well, let's be honest. You see tons